Hello everyone, welcome back to TechnoChart's YouTube channel. And in today's video, I'm going to talk about an intraday mean reversion trading strategy that is also known as backup. So in the last video, we talked about what was mean reversion, where a stock generally pullbacks to the moving averages after huge gap up or gap down. So in the last video, we talked about whenever the stock opens huge gap up, the stocks have a tendency to pull back to the moving averages and then take support. After that, the stock may or may not generally pull back, or you can say may or may not bounce back again, right? So in this case, what we can say is basically a stock that has a tendency to pull back to the moving averages after the stock has opened gap down, that is known as a backup. That is what we have designed as a backup trading strategy, right? So mean reversion is a concept in finance that suggests that after an extreme price move, stock prices tend to return to regular or average levels, and prices do not move away from the mean sometimes but revert to the mean price over the period of time. So as you can see here, in case of bank nifty, here we can see the chart of bank nifty. Now bank nifty opened huge gap down here, and then after that you see that bank nifty stays sideways for the whole day. So similar thing happened on this day, where bank nifty opened huge gap down and then bank nifty stayed sideways for the whole day. So generally what happens is, after a move has happened in any of the stocks, and the stocks, if the stocks fall down or open gap down on the next day, you will see the stock are pulling back to the moving averages again and again. So in this case, what we can say is, after an extreme price move away from the mean, these are very hard to sustain for extended periods, and they will tend to come back to the moving averages. So these are some of the examples that we have talked about, where generally, even after intraday, let's say that after a huge selling has happened in any of the stock, if we open the stock chart of Star or Strides Pharma, then you'll see after the stock has fallen huge in a continuous manner, then if we check the charts at this price, you'll see how the stock will generally pull back to the moving averages, how the stock will generally pull back to the moving averages. So this keeps on repeating again and again and again and again, and that is what we are trying to capture the move, right? So what is the hypothesis? Whenever a stock opens gap down considerably, they will tend to come back to the mean levels. That is first thing. Backtesting, here we have done this backtesting on NIFTY50 Universe, as the probability is are calculated on the stocks that have highest chance based on the historical data. So there may be 10 stocks that are opening gap down. Let's say there are 10 stocks that are opening gap down. So not all the stocks will have the tendency to come back to the moving averages, right? So the tendency, the stocks that have the highest tendency are captured, and then they are given as a recommendation, as a trade recommendation in the Telegram channel. So if you want to trade this strategy, you can join the Telegram channel, which is there in the description below. You can click on that link and join, and you will get the trade recommendations based on the same theory that we have used. So backtesting is done on NIFTY50 Universe here, and the probabilities are basically calculated on the stocks that have highest chance to fall based on historical data. And now the universe of stocks, basically in the last model we backtested on Nifty 500, and in this model we are trying to test the strategy on Nifty 50, because the odds of an upward mean reversion is greater in Nifty 50 than compared to Nifty 500, as Nifty 50 has a huge heavyweights, right? So what are the intraday and exit rules? So intraday entry is generally done at 9:16 a.m. and 9:16 to 9:20, and the stop loss is max 5% from the entry price for the day, right? So the capital that is suggested to trade the strategy is around 1.5 lakh rupees. This does not include the broker, the margin that is provided by the broker. So we are not talking about the margin that is there. We need around 1 lakh 50,000 cash as a for trading the strategy, and the capital deployed that is there is maximum 1 lakh rupees. Now 50,000 is kept as a additional buffer for the drawdown and all, and that is what we are not using the additional strategy, the additional capital, right? Now in case of universal exit is generally at 3:10 to 3:15 p.m., and that is what is the universal exit. So we are not having any kind of targets in such like that. So you can follow the stop loss, either it is stop loss or the universal exit. Now as you can see in the example here, where Hindustan Unilever opened around 1% gap down and around moved around 1.5% up for in that particular day, right, and then moved sideways. So you will see that there are a lot of stocks that would be opening gap down and then they are moving back to the um, moving averages. So for example, Z Entertainment, even though on this day there were many other stocks that have opened more gap down than Z Entertainment, but our algorithm calculates the probability of the stock which has the highest probability to move to the moving averages. So these probabilities are calculated and you will not find the screener for the stocks anywhere in the social media. For that you need to join the description, or you need to join the Telegram that is there in the description below. Yeah. Now Z opened around 0.5% gap down, and this was a live trade that was given on the 31st of June, and the stock moved around 5.3% up on that particular day. Similar example is of Shri Cement, where the stock opened gap down around 2 to 3%, and the stock gave around 100 rupees per particular share. Right. So apart from that, there are many other losing trades also for this particular strategy, as we need to know the pros and cons of the strategy. We need to know also the winning and the losing trade. So generally what happens is, if the stock opens a huge gap down and there is a follow through happening, then the stock may stay sideways also for that particular day, and it may or may not pull back, right? So what happens is, generally you'll see that the stock has opened huge gap down. Let's say this is the moving average. The stock has opened huge gap down. So in this case, the stock will move sideways completely, and the moving average will generally try to come back or try to come near the price in this case, right? So this is one of the most common things that you can see whenever that stock is opening gap down, right? Now let's take one more example where the stock stayed sideways for the whole day. Example is ONGC, where the stock opened 4.5% gap down, but the stock stayed sideways and closed at a minor loss. So these are the particular days where the stock can stay sideways. One more example is of Bharti Airtel, where the long entry was given at around 9:15 to 9:20 a.m., but the stock stayed sideways and did not pull back to the moving averages. But the moving averages came near to the price, right? So it could happen like that also. Now, what is the model backtest and statistics basically? So the model was trained for 7 years, where we covered mostly all types of markets like bullish, bearish, and sideways. So you cannot, so that we are able to test this model in all the scenarios. Now, this is generally an income generation model, where we are trying to capture the profits and not use the profits to compound the results, right? So we will withdraw the profit from the strategy, whatever the profit and loss that we make. Now the universe that we have tested is Nifty 50 basically, and gap down long model, that is with the 5% SL. Now the average win size is around 1.84, that is on a capital of 1 lakh rupees. The average money, the average profit that we have made is around 1,840 rupees, that is 1.84 rupees. The profit factor is 1.97. The biggest winner is, so the biggest winner is 17.3. 17.3 basically means on a particular day we made around 17,300 rupees on a capital of 1 lakh. And the biggest loser is basically 5% SL, that is minus 5,000. Right. So the expectancy is 0.36. Now expectancy of this model is a little less. The expectancy should be at around 0.5. So the thing is, you will have to combine multiple strategies and trade different strategies, so that overall the basket of your strategies has a good expectancy. Some of my strategies that I trade even in options have very less expectancy, but the other strategies have a higher expectancy, and overall the expectancy comes out at an average level, and that is what you need to trade multiple strategies with different expectancies, right? So max drawdown is around minus 21,000. That is why we have kept the you can see the capital at around 1,50,000. So even after maximum drawdown, we'll have the capital to trade. So here the number means that how much profits were down from the peak profits that we made in the particular month. Basically, this is the monthly drawdown of backup portfolio. So currently you'll see that the gap downs that are opening in the recent market conditions are not having a follow through buying basically. So That is the problem. That is one of the cons of the strategy, that if the market conditions are weak, even after gap down, the stocks are not pulling back to the averages. So compared to backup quick short, that is the other strategy that we have discussed. I will share in the I button. You can see in the I button that the other strategy that we have discussed basically is a better strategy in terms of risk to reward, in terms of everything, and the monthly heat map of signals. So basically this gives a very low signals. The number of signals that are there in the model are really less. So but yeah, they may have a high probability of the trades. So these are the percentage returns in a given month, for example, that is there. So in the month of March we made around 29,000 on a capital of 1 lakh rupees, and in the month of May we lost around 3.8 thousand on a capital of 1 lakh rupees, so around 3.8% drawdown, right? What are the pros and cons of the strategy? Basically the pros are, there is no overnight risk in the strategy. These have given consistent returns over a period of time, and limited high probability trades. The cons are high drawdown. Basically 20% is the maximum drawdown that is there around on a capital of 1 lakh, and a high risk of up to 5% of capital on a particular day. So that is also one more con of the strategy. Now what is the how to position size? Basically, now Bharti Airtel is given as a long signal at 9 a.m. So basically you can't go and buy at 9 a.m., right? So you'll have to wait till 9:17, 9:20 a.m. Stop loss is 5%. Position sizing is deployed capital divided by stock price. So 1 lakh divided by 678 is the total of approximately 145 quantity of Bharti Airtel that you need to buy. What are the risks of the model? Basically, so if you do not execute using limited limit orders, basically, then order slippages can be huge. Second thing is, you have to trade the model every day. You have to trade the stock every day, because even if you miss one day, that one day could be the highest profit day in your in the model. So you'll have to do that thing, and you cannot randomly participate. You'll have to trade every day. Otherwise, you do not trade the strategy, basically. Now if you like the strategy, if you want to try the strategy, I will share the Telegram link in the description below of the investment app, and you can join their beta program also to understand more about different quantitative strategies which have thorough backtesting. They have their own proprietary algorithms to model different kind of equity strategies also. If you like the video, do share it with your friends, and do not forget to watch the quick shot video that is even more interesting than this model. Thank you. Have a great day.